U.S. government debt has always been viewed as a relatively safe investment, but the worst downturn since the Great Depression and continued economic uncertainty have led to a huge rally in the bond market and the lowest yields in decades. In fact, the Federal Reserve's recent promise to step in again if the economy doesn't improve sent the yield on the two-year note to its lowest level ever. Now, many investors are asking, are Treasuries still safe, or is the bubble about to burst? Mike Larson, Steve Chapman, and Monty Agarwal are here to debate that question and much more. We'll discuss the Fed's stance on interest rates and inflation and whether another round of quantitative easing will do more harm than good. And we'll ask if it's a good idea to be chasing yields in corporate bonds. Plus, Jen Amos is back with picks and pans from all the Weiss research editors. All that and a closing comment from Martin Weiss coming up right now.
From our studios in Jupiter, Florida, Weiss Money Network presents Money and Markets. And now, Jamie Holmes.
Hello, everyone. Uncertainty in the financial markets has caused interest rates to fall to historic lows as investors rush to the perceived safety of Treasuries. Our first guest this week has been warning about that trend for months now. Mike Larson is an interest rate and financial specialist at Weiss Research. He's also the editor of the Safe Money Report. Mike, so good to see you.
Glad to be here.
Mike, what are you seeing in the bond market right now?
Sure, Jamie. What you're seeing right now is an intense hunt for yield. With the Fed pegging interest rates down at 0%, you have income investors, whether they're pension funds, individual investors, or what have you, that really need to earn a certain return, and they can't get it in Treasuries. They can't get it in short-term bonds. So they're really going further out on the risk curve and on the interest rate curve. That means they're buying junk bonds, they're buying corporate bonds, they're buying foreign bonds. And instead of buying 1 or 2 year securities, they're buying 5, 10, and 30-year securities. The Fed is trying to do that on purpose, essentially, to force people to extend and chase risk to help bring down corporate borrowing costs, bring down consumer borrowing costs, and thereby recharge the economy. But I don't see a lot of economic revival happening. I think essentially they're forcing people to chase these bonds, but they're not getting much bang for their buck on the economic side.
Mike, there seems to be some internal dissent within the Fed about their monetary policy. Now, what do you think the outcome of that internal debate is ultimately going to be?
Sure. Well, I think most of the Fed is happy with keeping the official interest rate, the federal funds rate, at 0%. But the debate now has shifted to whether or not to do this thing called quantitative easing. Essentially, in layman's terms, print money and buy assets, whether that's Treasuries, whether that's junk bonds, whether that's mortgages, heck, it could even be stocks. Many on the Fed are uncomfortable about what that might mean for future inflation and uncomfortable about the distortions that might introduce in the market. I mean, this is a Fed that under various leadership, whether it was Bernanke, Greenspan, or what have you, helped create a dot-com bubble by keeping money too cheap and easy, and then helped create a housing bubble by doing it again. So I think some on the Fed are concerned if we go down this same path, we're going to end up with the same result.
Okay, Mike, what is your outlook for the bond market and for interest rates going forward?
Well, sure. I think the Fed can help hold down interest rates for a while. The market, for now, is cooperating with that. But again, when you look at some of the results of the Fed's easy money policy, you see some chasing of very high-risk stocks. You see commodity prices going up again. You see gold, hitting $1,300 an ounce. I think at some point, the bond market and investors overall are going to get nervous about the ultimate impact of all this cheap and easy money. There is no free lunch. So I think ultimately, along with the large deficits we're running, Fed policy is going to help drive interest rates up and bond prices down.
I want to ask you about corporate bonds. What opportunities exist in that market?
Sure. Well, again, I don't think in corporate bonds you want to be out there buying willy-nilly, buying the entire market, because there is a sense that you're not getting compensated for the risk you're taking on. I mean, Microsoft just sold several $1 billion worth of short-term bonds for the lowest interest rates in corporate bond history. You can pick and choose among some of the safer sectors. You might want to buy the debt of, say, consumer products companies or utilities. But all in all, I wouldn't just buy the whole market, because I think you really you're not getting compensated big picture on the risk you're taking on.
Mike Larson, thank you, sir.
Thanks, Jamie.
Our next guest is a portfolio manager who watches the current interest rate environment very closely, and he's a bit more optimistic about Treasuries. Steve Chapman is here. He's the vice president of Weiss Capital Management and a former bond trader. Steve Chapman, always great to have you here on the set.
Nice to be with you, Jamie.
All right, question number one here for you, sir. Why do you think that there's still some opportunity out there for investors when it comes to the bond market?
Simply because I think from a global standpoint, we have so many problems worldwide in various different countries. There's going to be mistakes made along the way. Meanwhile, there's going to be flights to quality. Treasuries are going to be in a great position to benefit from that. In fact, if you go back and just look from December of 2008, the 10-year bond today, we're actually only 20% higher today than we were then, and the long bond we're 33% higher. So actually, the bond market could go another, on the long end, 33%. Up in price just to get back to where it was, not even counting a new round of fresh problems. So I think Treasuries, as long as they're going to be viewed as a safe haven, they're the most liquid investment on earth. They're going to be popular as long as these problems persist.
Okay, Steve, we're obviously in a deflationary period right
Yeah.
now. A lot of experts predicting that inflation is just around the corner.
Yeah.
Now, what is that going to do to bond prices? Wouldn't that destroy them?
Absolutely, it would. I mean, inflation is the arch enemy of bonds. I am not personally worried about inflation for a couple of reasons. At least not now. Right now, I think deflation is the order of the day. But the idea is that the Fed has come out and pronounced that inflation is actually dead, so much so in their last announcement, they're concerned that it was getting too low, number one. Number two, they've also been announcing for the last 2 years that they're going to maintain rates at a long time at very, very low rates. And Bernanke, being a student of the Depression, as he was, he knows one of the big key problems that they went through then was to raise the rates too quickly. And so he is not going to do that on the markets again. He's not going to make that mistake twice. So I think what he's going to say to us, he's going to telegraph those moves, and we're going to be able to make adjustments accordingly. And there are tools that you can use to actually protect yourself from a deflationary to an inflationary
Well, let's talk
environment.
about that.
Okay.
What tools specifically can you use for
Well,
inflation and deflation?
Sure. Well, actually, going from a deflationary environment to an inflationary environment, bond prices are going to collapse. So there's a couple things you can do. A, you want to stick with higher quality bonds. You want to move in the yield curve to where the value of the changes are smaller. Number one. Number two, you could actually move to cash as an option. But another way that people can use it is by using an inverse investment. You've heard, I know a lot of conversations you've had on your show about inverse investments, inverse ETFs. I use inverse mutual funds, and I'm suggesting some of the clients and your viewers could use them as well, meaning you can actually use them to create a synthetic security. And what I mean by that, you could take a bond, let's say a junk bond. People like junk bonds because they like the 8% cash flow that they produce. But what they don't like is the potential problem they might have with the price. So I like the 8%, but I don't want the price to drop. If you were, in fact, to buy an inverse junk bond fund and compared that and melded that to your first investment, you could actually hedge off price move and capture the 8%. So you neutralize the price drop, but you still get to enjoy the cash flow. So you can use that as a very effective tool to mitigate price drops in this environment and absolutely give you a steady stream of income without putting your principal at a price risk. So
now, a lot of dividend-paying stocks are offering much better yields now than what Treasuries have been offering. Now, why aren't you recommending those to your clients?
That's a great question, and we get that one a lot, simply because of the senior status of bonds. And that's what I'm going to cut right to that. Because, for example, if you had a stock that pays a dividend, there's two components there. The stock value is based on the fact that the stock does indeed pay a dividend. Now, the other feature that a dividend-paying stock has, that if the company does not have enough income, let's say, for example, to pay the dividend, they can suspend it. So two things would happen. Your cash flow would stop, number one, and number two, the inherent value of that stock would drop, number two, because the dividend was taken away from you. We don't want that. So I'm suggesting if you go up to the bond level, same company, if you like the company, just move up the ladder in seniority. They cannot suspend a bond payment because that would be called a default, number one. So you're going to maintain your cash flow that you had, and number two, you're going to have a lot less volatility being in the bond market than vis-a-vis the stock market. So if you had a Johnson & Johnson dividend-paying stock and you like that, I'm suggesting take a look at the Johnson & Johnson bond, get the same company, but a higher yield, maybe, and certainly a lot less volatility, and no chance that they're going to cut that interest payment off for you.
Okay, Steve Chapman, thank you, sir.
Thanks, Jamie.
Okay, coming up next, we're going to take a look at some ways investors can take advantage of the current interest rate environment. Jen Amos will be here with this week's Picks and Pans, compiled from the recommendations of all the Weiss research editors. And a bit later, Steve and Mike will both be back, along with Monty Agrawal, for a roundtable discussion on the bond market. As always, if you have a question for any of our guests or a suggestion for a topic that you'd like us to cover, just email us here at Weiss Money Network at weissinc.com. Now, we may not be able to respond to all of your emails or address them on air, but we're keeping them all on hand for future episodes, and we appreciate your feedback. Money and Markets will be back in just a moment.